So how many of you all have heard of cryptocurrency arbitrage before and wonder what it's all about? Well, this is a technique that many people have used in this young crypto world to make quite a bit of money and potentially a less riskier way than the traditional ways of trading like swing trading or day trading. So if you're curious about this topic and haven't looked into it yourself, then have no fear, because I've created an overview of this topic for you. All you have to do to learn more, it's just keep on watching. Hi everyone from Random Idea and welcome back to our channel. The coming weeks for you all to continue to learn more about the crypto space, even though the market is still down. So real quick before we dive in, if you can support me by smashing a like button and subscribing down below if you haven't already, that would help me out immensely. Okay, so let's get started. So what is arbitrage on the highest level? Well, first of all, to do this you need to find an asset that has different prices even though it's the same asset in different markets. You can do this technique with stocks, bonds, forex, and more. Basically the idea is that you buy this asset in one market and then sell it in another market where it's a different price to profit off the difference. This is considered a risk-free trade, or pretty close to it if there ever is one. That's why it's kind of hard to find in traditional markets, because it's an old technique and many people are already taking advantage of it or has systems in place. Automated systems do most of the arbitrage trades these days to keep price stable across markets, and I can't really do this anymore. However, what about in the crypto world? Because this is quite a different market. That's why retail traders like you from the traditional ones, there's over 200 exchanges with a large price distribution. Just going to look at coin market, Capcom, click on a coin and click in markets. You can see all the price differences. They are due to imbalances in supply and demand and also price discovery. It's kind of done separately for each exchange, so you have larger changes with liquidity driving the price and then small ones following them, but it's not immediately. Sometimes the big ones change and then the small ones are slow to catch on. That is where the arbitrage opportunities exist. Example is a kimchi premium. Remember, back in the bull run, South Korea had a huge premium, like 30% or something like the ton Bitcoin. So if it was selling for this amount of dollars here, it would be even more, 30% more in South Korea, and that is called the kimchi premium. A great example of arbitrage opportunities. There are many different types of arbitrage. The simple type, fiat triangular arbitrage, crypto triangular convergence, catch and carry, and we're going to take a look at each and every one of them in case you're curious. Simple arbitrage is quite simple. You buy a coin in one exchange and sell it on another exchange at the same time or close to the same time. You can earn the spread, which is the difference between the prices, instantly in this case. So in some situations you can transfer the coins between exchanges, but that takes some time. Another technique to do this is to have fiat and crypto balances on both exchanges, so you can effectively buy and sell on one exchange in another one at the same time. Here's an example. Litecoin is $60 on Finance and $62 on Coinbase. You can buy 50 Litecoins on Finance and sell 50 on Coinbase and earn an instant $100 profit. Now, what about fiat triangular arbitrage? What is this all about? This is when you have three assets or asset pairs involved with one shared asset between the pairs. Example is Bitcoin USD and Bitcoin Korean won. Now Bitcoin is a shared asset, but there's three total that we're dealing with here. Example, buy one Bitcoin for 30,000 other Coinbase, send it to a Korean exchange and sell it for 4,200 worth off Korea wants, and then you can convert your Korea wants to USD at a bank per se for 400 profits. His opportunity is often there for exchanges serving local or regional markets. Now you can also do this triangular type of arbitrage with crypto. Even within one exchange you can apply this technique. So how does this work? Well, you take an advantage of mispricing between three pairs of coins. For example, if you're in Bitcoin, if they're in my coin and like one Bitcoin, they kind of form a circle triangle per se. So if you recall, or look on CoinMarketCap.com, the ratios between the coins are denoted in USD value as well. That's why you can take advantage of arbitrage. For example, let's say DRI, AM converted to Bitcoin and Litecoin converted Bitcoin. those are two separate markets, right? So they have different supply and demand. That's why there are price differences, and that's how you can take advantage by going through the pairs to get that price differential in terms of USD value, and you can make more Bitcoin or whatever coin you're trying to make in that scenario, and there are also bots available to do this. Next up, convergence arbitrage. This is based on the idea that when there's market inefficiencies, eventually the prices will converge due to other people, for example, taking advantage of arbitrage opportunities. So, what you can do is buy this coin on exchange where it's undervalued, and then you short sell it on exchange where it's overvalued. So of course you need to find an exchange that allows shorting of that particular coin.